Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 1st of December. I'm Daniel Lam, your host for the podcast. We've been getting some feedback on our opportunistic idea on US pharmaceuticals, so I would like to dig deeper today. First of all, pharmaceuticals do not equal to healthcare. Yes, some may think they're the same, but actually, US healthcare sector is split between pharmaceuticals, biotechnology and life sciences, which is 60% of the index, and healthcare equipment and services, that's 40% of the index. Now we expect the pharma and biotech sub-industry to be the primary growth driver. We're projecting 12.4% earnings growth in this sub-industry in the next 12 months versus a 9.7% growth for the broader sector. Regulatory risks are receding for large-cap biopharma companies with government deals on tariffs and expansion of Medicare coverage for innovative therapies like GLP-1s. They serve as a key positive catalyst. Now, for the healthcare equipment and services segment, we're projecting a more moderate earnings outlook. But having said that, it does offer stable and defensive growth qualities with innovation and accelerated robotic surgery adoption, providing solid tailwinds. From a valuation perspective, overall, healthcare sector's strong rally has led to more crowded investor positioning and recovering valuation. But it is still trading at a 15.2% discount to the broader US market, which is lower than the 10-year average at 10.8% discount. So therefore, we would be focusing upon pharmaceuticals and adding in tranches to capitalize on potential re-rating. Now, this is a very interesting time for the markets, where investors are quite undecided and even somewhat nervous. Just take a look at the flip-flopping of rate cut expectations for the Fed. That had been dropping since early November to 30% at one stage, and then suddenly went up to 80% last week on the back of dovish comments from Williams, the New York Fed president. There were also fears about the excessive capex in AI and competition in the high-end semiconductor space. Nonetheless, regardless of whether the Fed would be cutting in the coming week or not, US pharmaceuticals, they do have very good and stable earnings. So this is the reason why adding US pharmaceuticals has been getting the attention. If markets do not pull back from here, then at least you would have added some exposure. If markets do pull back, then the stable earnings in US pharmaceuticals means good defensive qualities during corrections. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.